Hello, hello, hello. What's going on, everybody? Welcome to a Capital Hungry educational webinar. This is one of our routine macro higher time frame analysis webinars that we do every month and every quarter. The reason for this is that some people in Capital Hungry swing trade or use the insights and information for potential investing purposes if they choose to. And it also gives us a bit of a refresher where we can zoom out from being so focused in on the smaller time frames and get a good bird's eye view to understand the higher time frame positioning and the macro fundamentals in play, which can further support our trading psychology to be more zoomed out, reset, refocus, and not so much lost in the lower time frame noise. And it can also just help us identify opportunities of certain key higher time frame prices we may retest for great trades, or certain areas we can look to target for potential exiting of positions or reassessing analysis accordingly. With this one, it's going to be the routine. First, we're going to start off with gold. We're going to review from our last macro webinar, then talk about where we are right now and what's driving price. We're going to look at dollar individually first, then a quick scan on the dollar pairs. We're going to look at Japanese yen individually, then a quick scan on GJ, and then we'll check out US 30 as well. Oops. Sorry about the flashbang there. Okay, starting out with gold. Our last macro analysis, we were looking for one of two things here. That if gold didn't break out into new highs, getting a pullback to retest into the 1920s and retesting higher time frame bullish market structure before continuing the bulls, or we would be looking for the bullish continuations well back above the 2080s. Now, initially, we did show signs of exhaustion up here in the 2075s and 2080s. We started to get a bit of a bearish pullback phase taking place, but unfortunately, we did not get that deeper extended pullback to retest into the deeper 1920s to get some better higher time frame positioning or even some great day trade positioning there as well. Instead, what we started to notice with an abnormal breakout over here into the 2100s is that central banks have been actively increasing their gold holdings, increasing at a pretty aggressive rate. Central banks increasing their gold holdings, plus dollar moving more just sideways from a higher time frame perspective. And at that time, rate cut bets still being priced in and holding the most weight led to a breakout and just the continuation upside moves here. So we didn't get that pullback phase, but we got the breakout instead. And in Capital Hungry, we started adapting well above the 2100s. And currently, even with the weekly open, factoring in how the PCE data and Jerome Powell sentiment of having the neutral to dovish tone last week was, as it ended up being on the bank holiday. So we saw a more aggressive gap up and continuation of price today. We're up into the 2250s. Now, from the last maybe 10 gold macro webinars, we've been higher time frame bullish. You'd have to be pretty retarded not to be bullish every time we're scanning the 6-month time frame, scanning the quarterly time frame, which you can see. Also, we got this very clean quarterly candle closing well above the previous significant wick highs here and candle body high. So it does look like we might not get any type of deeper extended pullbacks. It does look like from a higher time frame positioning, we've already seen that accumulation phase take place from the pandemic all the way into 2023. we've already had this bit of an accumulation phase here, while still respecting higher time frame bullish structure. So we may see on gold, especially if we see any further geopolitical tensions coming into play, central banks continuing to increase their gold holdings to hedge against recessionary risks, as we still have yet to see policy lag effects from the tighter financial conditions, interest rates being up higher for longer. The policy lag effects basically just explains how the tighter financial conditions will hold a negative impact on economic activity and economic data. That's why we've already seen countless times the Feds themselves repeat that they still expect to see unemployment rate increase and GDP in these figures drop, but they've been extremely surprised on how resilient the US economy has remained, with obviously the amount of liquidity that was flooded into the system during the pandemic period. So this is looking like a situation where we might not see another higher time frame pullback unless we have catalysts to support so, whether impacting gold supply or demand, whether from a central banking policy positioning perspective, or whether from a US data perspective. Right now, when we look at the US economy side, the Fed's job on inflation is yet to be complete. And if policy lag effects do start to come further into play deeper into 2024, Q2 and Q3, obviously we're starting Q2 now, which what we've been anticipating for. If those policy lag effects are coming into play and we start to see declines in US economic data with increases in the unemployment rate, weakening in PMI figures, starting to see dollar drop off more bearish after potentially retesting range highs, which I'll show you guys and talk about later on in this webinar. But if we see that weakening in the US economy, that alone is still more bullish for gold. Catalyst for central banks to continue increasing their gold holdings as well. The same time, dollar would be softer and seeing further outflows, and rate cut bets would be holding even more weight because of recessionary scares. So we're potentially starting to see where, since we didn't get the deeper pullback phases like 2023 and so forth here, this was the extent of the pullback from the 2022 rate hike cycle, which we even at that time during the rate hike cycle in 2022, we wanted an extra leg down further into the 1500s before seeing buys during that dollar domination phase, if any of you remember that. So it looks like since we didn't get that deeper pullback phase there and that leg down during the 2022 dollar domination phase where we had the Feds doing the most aggressive rate hike cycle in history, instead, the secondary phase of market structure looks more like an accumulation here, very similar to the post 2008 GFC period, where we just had an accumulation instead of any deeper pullback phases, still respecting higher time frame structure. That's pretty much looking like what we had take place here. So with that being the case, we may see some intraday pullbacks on gold, like potential wicks being created back into like the 2100s or something before continuing higher. But it doesn't look like gold's going to be doing some heavy reversal yet anytime soon. What it does look like gold could be doing is having a similar sequence of events here, where we could see a pretty aggressive leg to the upside here, even going into like the 2500s or deeper before seeing new all-time highs being printed and much more aggressive pullback phases that can be years down the line. When we're looking at this type of timeline, of course. Right? So right now, when we're looking at that gold structure, with the majority of market liquidity inflows still in asset classes and outside of currencies, Like we're mainly seeing it in the stock market, in crypto, real estate, in commodities across the board, gold here as well. With that still being active, rate cut bets still being active as well, and that market greed. Dollar more just ranging, moving sideways on the higher time frame here. Still the risk of geopolitical tensions to arise. Still the risk of seeing weaker US economic data um, due to policy lag effects, which obviously would increase gold's safe haven appeal. There is a ton of bullish fundamental support for gold still. But the thing is, right now we're going into price discovery mode. So what we can anticipate if we're looking at a previous sequence of events of an accumulation and a breakout on the higher time frame is potentially measuring this last one here and getting a little bit of an average. So we can see roughly here after the 2008 global financial crisis, then you had the taper tantrum at that time, where the Feds were aggressive with tightening conditions through very aggressive tapering under Bernanke, when Bernanke was the head of the Federal Reserve. You had a more aggressive pullback phase, but then you can see gold consolidated for a period of time, few years actually, before really having more fundamental events driving upside, which we'll break down here in a second. So the rough consolidation accumulation we can highlight around here, right? Then you can see release some of this extra stuff. Once we had an actual breakout, we had an impulsive leg up for a pretty consistent period of time, pretty much remaining through the entirety of that year, of almost a 47% move here on gold, right? Pretty interesting. Even into the GFC, it was quite large, but I don't think we're going to be seeing anything as high impact as a GFC. I'm going to take this as a potential reference point just because it's a similar point of structure where you had an accumulation phase and then a breakout there. So right now, when we're looking at gold, we can see a similar type of accumulation phase that took place here. The 2022 front loading of rate hikes and tightening of financial conditions by the Fed didn't lead to the deeper pullbacks to the 1500s, but ended up snapping pretty much from the 1600s up when we started to get the banking sector fails, geopolitical tensions coming in a year later, rate cut bets starting to come in with inflation starting to go down and the base effect taking place there. But we didn't get that deeper pullback. So instead, we had the accumulation. Now, similar to here from a technical perspective, you can see on the higher time frame, the accumulation was pretty much roughly into the deeper 2000s here. If we're just going to see a similar higher time frame impulsive leg up with still seeing heavy liquidity in asset classes, not as much liquidity into the currencies there, and still having the potential for geopolitical tensions coming to the table, policy lag effects, and so forth. From the breakout point, we could easily, if it's going to be something similar, we could easily be going into the 2800s, 2900s, no problem. Right? It doesn't look like we have anything to be really leading to a more aggressive bearish pullback phase. We may see some aggressive intraday bearish pullback phases during some times where you just have regular profit taking moves, exchanging of hands taking place from an algorithmic perspective, or certain periods of times where you're going to see some rebounding economic data and a little bit of less appeal to gold safe haven side and less demand from that angle, impact on treasuries and so forth, right? But from a higher time frame perspective, it doesn't look like we're going to be seeing an aggressive pullback. It looks like we're going to be seeing a melt up. Does that make sense to everybody so far? And the same time, we just have to be very reactive. This is a macro webinar, but the one thing we have to understand is it's not like when we were seeing the breakout of this accumulation and you at least had historical levels to play from the GFC event, right? You had historical data to play. The tricky part this time is we're in price discovery mode. Yes, you can use certain indicators or measurements of price momentum and movement, like EMAs or so forth, to anticipate levels. But what I found has been pretty awesome is in price discovery mode is just really going down to the lower time frames and seeing where you're having the algos do the most aggressive reactions, both on the buy and sell side. Clearly, obviously, something's going on there. You get what I'm saying? And we've been doing that so far, and the levels have been pretty good. Like just to do a quick lower time frame, even with this volatile market open we've had, you can see like these breakout, like these levels we already had mapped out when we were in price discovery mode. Even as we've been revisiting them and having pullbacks, we can see where the lower time frame supports are being created, where we're seeing the strongest reactions to identify levels. Even so far, we saw this pullback to 2236, which was already a level from the highs printed last week, which you're obviously going to mark down there, and been seeing the upside sense still, right? So I think like really just getting to the nitty gritty and analyzing on the lower time frame where you're getting the best reactions on the buy and sell side is going to be our levels to play, not just in the near term, but also in the future, right? But anyway, so now what I would prefer though, this new quarterly candle, which just has opened up, I would prefer to see some larger lower wick being created just from a technical perspective, see some more buy side orders being accumulated, which from like an intraday perspective would just be an aggressive pullback so we can load up more buys and start riding that potential melt up and probably majority of risk assets still, right? Unless there's some black swan event, like the greed train is still far too strong. And we may only see a short-term pullback when the feds actually do cut rates for like a buy the rumor, sell the news play, like we were talking about. And by short-term pullback from a macro perspective, I mean it could last a couple of weeks or couple of months. But in reference to this overall structure and what we've seen so far, we saw a very fat accumulation and finally getting a clean breakout with fundamental supporting factors, especially the central banks increasing their gold holdings. So we're still very bullish on the macro for gold here, with potential to go heavy, deep, heavy into the 2800s, 2900s. When that's not really up to us. You know what I mean? Could be over the course of the next couple of years, as this is like a macro higher time frame webinar. Now, on the monthly, one thing we were looking for as well before this month was going to close off is if we could have gotten a cleaner pullback and retest into this structure point here, into the rough previous highs, 2040s, 2030s, before continuing higher. Instead, it looks like we just had that breakout, more order flow accumulated here, and a very strong breakout candle now. So it doesn't look like we're going to be seeing any aggressive pullback unless we start showing some signs of exhaustion on the intraday time frames of not consistently breaking out into new highs and then getting some intermarket correlation confirms when we're looking at the price movement in other risk assets and asset classes overall. And when I was looking at it on the weekly, that was us just wanting this pullback to extend a little bit deeper into the 1920s, like we were talking about, before starting to continue the bulls. Remember, we were talking about that structure point there, which would have been perfect. That would have been fantastic before this leg to the upside. But hey, man, what can you do? You don't always get those exact picture perfect plays you want, but it would have been very nice. You know what I mean? Would have been perfect. Yeah, just like 2 more weeks of downside and then boom. But it is what it is. We don't have that insider information. If anybody does in Capital Hungry, make sure you don't keep it to yourself. But anyways, from a technical perspective, with central banks increasing their gold holdings, rate cut bets still holding the most weight, majority of liquidity still in major asset classes, we had this bit of a wedge pattern in accumulation here in breakout. I don't think we're going to be getting a pullback to this structure anytime soon. It is still some beautiful structure to keep an eye on from a macro perspective, of course. But we can see that we had a bit of a technical support here into the 2160s. Now, right now, gold is still very bullish. I would really need this weekly candle and new quarterly candle flipping bearish to even be seeing a deeper intraday pullback into the 2160s before anticipating buys again. With obviously, if we start to see that deeper pullback taking place, 2160s being the first area of interest, we start to anticipate buys, but preferably even seeing a deeper leg down to a retest of this higher time frame structure and where we saw this previous accumulation and breakout of that wedge pattern into the lower 2000s here, right? But to take advantage of these higher time frame buy plays and swing positions, we would need to be validating some signs of exhaustion somewhere first. That doesn't mean we're looking for sells. It just means right now we're mentally preparing scenarios of what we would need to see to start seeing a pullback phase. So when that pullback takes place, you're not trying to buy every 30 pips that it's going down like an idiot. You get what I'm saying? Does that make sense to everybody? Because yes, gold can have beautiful bullish legs to the upside. Gold can run bullish hundreds of pips, thousands of pips. But what gold can also do for consecutive weeks and months is have vicious pullback phases, right? Somebody could have been extremely bullish on gold prior to this situation here in 2022 time from the 1600s, and then boom, that leg down. Obviously, that was the rate hike cycle, so we were bearish that time, anyways. It was the most aggressive rate hike cycle in history. Obviously, that's pretty obvious from a fundamental perspective. But I'm just saying, if you didn't know that was taking place, or you weren't adapting to those bears, and you're still in a bullish bias, that's obviously going to hurt you, right? Even look at this in relation to the upside. Beautiful bullish rally overall, very minimal pullbacks, peak out into the all-time highs at that time, into the deeper 2000s there, 2040s. But then for a consistent period of weeks, you can see pretty clean bearish structure holding some weight and then getting quite an aggressive pullback phase taking place that lasted months, faded out half of the previous upside before continuing the next rally, right? So that's what I'm talking about of why it's good to do these webinars is you can start to visualize these different scenarios in your mind, understand the fundamental supporting factors that can lead to that change in price movement and that change in transactions from the institutional algos, and then you can adapt accordingly. Now, in the example here on gold, where we're looking at current price positioning, we had the new quarterly candle from a technical perspective, the weekly candle, monthly candle, instantly open bullish and gap to the upside, and then just continue further bullish here into like the deeper 2255s, 2260s almost, right? If I want to see any sign of pullback on the macro here, we would need to be flipping bearish and showing more signs of exhaustion at a high on the intraday. And you can see gold does give you pretty clean signals when you're looking at weekly closures and starting to see exhaustion signs at a high and the potential for a secondary phase of market structure to be taking place. Right? It's very rare. It's not possible. It's not impossible, sorry, but it's very rare you just see gold push so impulsive on the higher time frame, like the daily and weekly candles, and then just instantly like snap back like that. And you completely miss the pullback or miss any type of intraday sales you may want to take place. With gold, when you're digging into a higher time frame price sensitivity area or an intraday point where you're starting to show some signs of exhaustion or getting short-term fundamentals going against the trend to lead to a pullback. Let's just say this is a higher time frame price point. Gold on the daily or weekly time frames does usually give you the confirms of starting to dig into the area, but wick and close with a weaker body. Potentially wick into that area multiple times, which is a lot of confirms on the intraday of exhaustion. And then start seeing the pullback phase take place, which you can see in like all these examples in yellow here, right? Right now, we don't really have that. We just have this gap to the upside and impulsive bullish price action because of the PCE impact and dovish Powell impact and the fact that it was on the bank holiday, right? So we saw a more aggressive open here. But we don't really have that yet. Can we start looking here into the 2060s, the new all-time highs printed? Sure. But we would want to see major signs of intraday exhaustion starting to shift the lower time frame bullish structure. And even more importantly, like on the weekly here and on the daily time frame, these candles that gapped open, flipping bearish to show us the potential of getting some deeper bearish pullbacks to retest into better buy zones. Right? Otherwise, if we don't get those confirms, it's honestly just keep buying gold. But be careful as it's in price discovery mode because outside of fundamentals to lead to a bearish move, you have to understand it's the market. And if we get into some very high prices and whales want to liquidate some positions and exit some profits out of the market, you are going to have that exchange of hands and natural bearish pullbacks take place, right? So just be careful as you're watching the positioning, use trailing stop losses or something, or if you get some impulsive profits, take some profits off the table and leave some runners. Because the one danger is obviously being in price discovery mode. We don't know where the algos are going to be looking to see some aggressive profit-taking moves. Yes, it can be near some 200 DMA or EMA, or if you want to map out a certain indicator, but it's not a guarantee, right? You get what I'm saying? But yeah, right now, if we don't get any signs of exhaustion, if we don't get a snapback below like the 2245s here, then there's probably a low chance we're going to get a higher time frame pullback into like the 2160s. And on the intraday time frames, we're probably just going to see some more continued upside still. right? Could even go into like the 2300s and so forth. We don't have any signs of exhaustion yet. So for the swing traders and higher time frame position traders that are looking for more positioning, these are some of the prices I'd be looking at. 2160 and of course into the 2040s here. Right now for the day traders and for the scalpers, we can do a webinar on it after, but gold's just looking bullish, right? Gold's just looking like you're going to be analyzing levels based on price discovery, using previous levels and lower time frame reactions, trying to catch some lower time frame pullbacks to better buy zones and just jumping in the buys until we show some major signs of rejection or exhaustion. But anyways, on the macro there, gold very bullish for all of those reasons. Any questions? Any questions on gold, macro, fundamentals, or technicals? Obviously, you can get into heavy nitty gritty and deeper central banking policy positioning, liquidity flows into treasuries and looking at the bond market, looking at debt cycles, and obviously looking at central bank holdings and COT reports. But I just like to look at a few certain aspects that make it very easily to digest for most people, and most people can follow along and understand why gold is going up. You get what I'm saying? New CBDs. CBD? You mean CB, the central bank digital currency? Or are you talking about the talking about the weed? Central bank digital currency, I don't see it having any type of impact on gold. BRICS either. Like I don't really see BRICS really doing anything that's gonna have major impact on gold pricing. Honestly, if central banks are increasing their gold holdings, to me, it just looks like hedging against certain future risks that may be coming to the table. And obviously increasing asset class value, moving from fiat's currency inflows to these major asset classes instead. One being obviously gold, something that historically has been recognized. But yeah, gold, all time frames, looking quite bullish. Even if you guys want a quick little intraday analysis, I know I'm going to do it tomorrow anyways with the weekly recap and refresher. But when we're looking at gold here, I like to zoom when we have this aggressive of movement. I like to zoom into the lower time frames to really identify structure. Actually, we had an accumulation here, so we can go even closer for some near time structure. And a bigger one there. I would love to see if we start to show signs of exhaustion and 2260 doesn't break higher. Would love to see that gap getting filled and even a retest into the 2236s again, 2230s before seeing some better intraday buys. Otherwise, if we don't get these signs of exhaustion at 2260 and we don't break below 2255s here, low chance we're going to be getting a pullback phase. And instead, we may see an accumulation in another breakout where I look for further breakout buys into 2260. Now, with the 2260 breakout buys, keep in mind you're going to be in price discovery mode. So be very careful with your positioning. You don't want to get caught in like a profit taking move, but the algos and getting swept in an aggressive pullback. So just be smart with your positioning there. But with the pullback phase, at least if you get the pullback and we hold into the deeper 2230s here, you at least have some targets to revisit the previous highs. But pretty nice structure. First area of interest for pullbacks would be into the mid 2230s here. Mid 2230s, low 2240s. Otherwise, it's just continuation 2260 buys. Okay, dollar. Now, with dollar, I do see the potential situation where dollar can still be bullish and gold can still be bullish at the same time. And other asset classes can still be bullish as well with more of the outflow out of your basket of risk currencies. If the other central banks are still expected to cut rates before the Fed, when you're looking at like the ECB, the Bank of England, we even saw the Swiss National Bank there do the surprise rate cut, which led to a little bit of more inflow into US dollar from an intraday perspective. If we see that still taking place, still respecting this higher time frame bullish structure, we may dig into this higher time frame supply zone or even at least the previous highs here before starting to see more any bearish rejections or sellers coming into play. What I'm also anticipating is when we see the actual rate cut by the Feds, we may see a short-term buy the rumor, sell the news play on equities, giving a bearish pullback on the US stock market. That's probably only going to be short-term, you know what I mean? Last a couple of weeks at most, maybe. But with that, we also still might see more inflows on the dollar because the markets have actually been pricing in the anticipation and expectations of multiple rate cuts this year for months now, right? So to me, if dollar isn't breaking below the low 100s here, still respecting this higher time frame structure, we can see that previous monthly candle close with a larger liquidity grab and still a bullish body here. To me, it looks like dollar can still be heading up into the 107.5s before anticipating price reactions and potentially even into the 112s before starting to see bears on the US dollar. Otherwise, if I want to be with a bearish bias on dollar now, I would need to be trading well below the 100s with very consistent weak US economic data, further feeding into rate cut bets, which we haven't seen recessionary scare data like that yet. Or we would need to see further inflows into your basket of risk currencies. So that could potentially come into play if these other central banks start to push back and delay their rate cuts and focus on keeping rates up higher for longer. if the inflation image globally is still sticky and troublesome back at these baseline levels. But for the time being, oh, sorry, I muted there. For the time being, dollar still looks like it could squeeze out a little bit more upside, in my opinion. We're still respecting that key area around the 102s. It looks like the next couple of months could still easily be squeezing into the deeper 106s, 107s before we see another bearish reaction and assess accordingly if we have enough volume and inflows to be going into the deeper 112s again. But minimum on the dollar, I would see us still going up into the deeper 107s. Mainly when you're looking at the dollar here, you can see when we were talking about gold, and I said we've seen further inflow into gold and these other asset classes. Well, fiat currencies have remained relatively softer in terms of liquidity inflows. You can see that on the dollar, where yes, you have intraday movement, you can trade on Euro USD, GU, and so forth. But overall, since 2023, dollar's been going sideways here, right? So all I'm pretty much saying on dollar is it looks like it could go to the top of the range before we see any further bearish moves. Potential pullbacks on the intraday to the 103.5s or just continued breakouts up into this bearish sell side zone before we may see any sign of exhaustion and bears coming to the table. So I'm still bullish on the dollar there for a little bit. Digging up into these higher time frame key prices. Feds have been taking everything slow and steady. US data has been in the middle, like not really seeing any crazy declines, still showing signs of resilience. We still have a bit of inflow into the dollar with expectations that some of the other major central banks may cut rates earlier than the Feds, right? But nothing huge, nothing like compared to the inflows we're seeing into the major asset classes, like equity still being bullish, gold still being bullish, and so forth. Crypto, Bitcoin bulls. I still want to ride Bitcoin into 80K, new all-time highs. But I'll talk about Bitcoin in another webinar. I think Bitcoin's still going to be riding bullish just with all the inflow into these major risk asset classes and bullish structure from a technical perspective. And I still think we could at least retest the last all-time highs or print some new all-time highs into like 80K even. But with the halving, what is it, April 20th on 420? Everybody's expecting Bitcoin to just go straight up. I think it's going to be a short-term buy the rumor, sell the news play, like with the ETFs, where the ETFs saw a bit of a bearish pullback phase first. I think we could see that on 420 there, April 20th. So something to look out for. But anyways, not too much to discuss on the dollar. I don't see Feds really in a bad spot. Inflation's probably just going to be fluctuating from hitting the 2% targets to 3% for the next months. Don't really see anything bringing major upside pressure to inflation at the moment. Just some very normal fluctuations that the market doesn't care about. Not enough to shake Powell's interest as well. He still thinks everything's looking great, fine and dandy, soft landing narrative. Feds are taking a slow and steady approach. US data is pretty neutral and monotone. You know what I'm saying? I see a bit of dollar upside, but it looks like dollar's just going to be moving sideways for a period of time. Does that make sense to everybody? Right? So with that being said, with some dollar upside, that means we could still be seeing some further Euro USD shorts, GBP USD shorts, but overall, we want to remain very adaptive with the dollar because it can get messy within this range. So we're going to be very adaptive to the collection of economic events and data reports, Fed speak, and obviously price action. But I would at least like to dig up into the deeper 106s and 107s before potentially seeing another bearish leg in the range here. Right? So when translating that to our pairs like GBP USD and Euro USD, that means I would like to see GBP USD, if we can break this intraday support level here, and dollar is holding a little bit more strength. UK, any potential recession scares, rate cut bets, feeding into some GBP outflows, and more continued greed in UK equity markets. I would like to see GU potentially retest into the 1.22s before assessing any higher time frame buy play positioning. Especially if we can't fade out this bearish move, dollars holding strength, we start to break below here. Which, when we're looking at the volume and volatility in currencies and FX compared to some of the other major asset classes, and looking at like commodities like gold and precious metal like gold, obviously, and equity markets, it could take a period of weeks to see that pullback phase take place, right? Euro USD, pretty similar idea. I don't see Euro USD going back to parity point with the dollar for no reason, but similar idea here. If we're not fading out that downside move, dollars holding strength, we're breaking below that weekly and daily support level, then we could easily retest into the 1.05s before anticipating any bullish bounce or intraday better buy positioning there. Right? Last but not least is Japanese yen. Now, Japanese yen is at some historical lows here, right? Obviously, from the last educational webinars and macro higher time frame updates, everybody and their grandmother is waiting for that Japanese yen generational swing carry trade, right? Bank of Japan finally raising interest rates, tightening financial conditions, stopping their bond buying program, and seeing some major strength in the Japanese yen. Outflows out of the Japanese stock market and major profit taking moves from the Japanese stock market. And these plays that can last months, if not years, to hold, scale in, day trade, and so forth. But because Bank of Japan has kept financial conditions so loose and done absurd things with their monetary policy, like their unlimited bond buying program. So they're like a 80% holder of Japanese government bonds, which is fucked up. It's like you're just buying and selling shit to yourself, right? It's very corrupt and manipulated, but we can't say shit about it. So, anyways, because the Japanese markets have been so propped up artificially based on this monstrous stimulus. And the Japanese economy itself isn't really the strongest. Like when you're looking at Japan as a landmass, it's not like you have major geographical resources. And when you're looking at Japan's population, it's pretty fucked up situation because the population is so aged and aging, and the workforce is starting to die out there, right? So a lot of the profits is really dependent on the corporate in industry side there and their foreign partnerships and foreign business, right? So with that being said, the reason why I'm saying all this is that there are major risks involved if the Bank of Japan gives the market signals too aggressively of unwinding their ultra loose policy and pivoting out of their ultra loose policy. There are major risks involved to the Japanese inflation picture. There are major risks involved to Japanese economic activity and corporate profits and investor profits within the Japanese markets. There's major negative impact involved to the Japanese government bond market, and you get the idea there. You get what I'm saying? Does that make sense to everybody? So this can be seen firsthand where even though Bank of Japan did their first rate hike in over 8 years, finally coming out of negative interest rate territory, they had to tiptoe around it and be so extremely dovish in their speech and be so front and forward to the public that they're still going to keep their bond buying program going, that they're not stopping their stimulus anytime soon, that they're going to be extremely slow and steady with increasing interest rates, that they even highlighted that there's major risks involved if they unwind policy too aggressively. That you can see Japanese yen didn't even pick up any strength from them raising rates after 8 years. An interest rate hike after 8 years got faded out by a monstrously dovish speech and statement. Why? Because they have to tiptoe around unwinding this policy. Now, overall, even the unlimited bond buying program will have to stop eventually, right? I don't know. I don't know when it's going to have to stop, but it will have to stop eventually. Otherwise, they're just creating further and further economic risk to be dealt with down the line. They're kicking the can down the road, to say, right? Now, eventually, I do think that when the other central banks cut rates and market liquidity is still going to be active with foreign flows, that's when Bank of Japan might start really unwinding their policy in terms of stopping their unlimited bond buying program and maybe being a bit more aggressive with their rate hikes. So it may take a little bit more time to see the generational trade take place. And conveniently, this lines pretty well with GJ, where we may even see the Japanese yen dig a little bit lower. Then we have to obviously look out for their bullshit stealth currency interventions from the Ministry of Finance. But we may even see the Japanese yen dig lower. GJ still go to Brexit crisis prices before we really see the generational swing trade taking place. And for me personally, I'm still just expecting to see yen revisit back into this point of interest here. Retest of structure, retest of this accumulation, and previous lows there, which is a monstrous move. That's like GJ right now going from the 190s back to like the 160s, 150s, right? But understanding how the Bank of Japan has to behave, it looks like they're going to be extremely slow and steady. And it looks like the Japanese yen is going to have some very sporadic movement at these lows with the risk of currency interventions. Japanese yen CPI data still holding above 2%, the mix of the Bank of Japan comments. And they're really going to try to make it as annoying as possible to be getting involved in the generational Japanese yen swing trade because they're going to be taking such a slow and steady tiptoe approach to make sure that they don't break anything. Does that make sense to everybody? It's something we talked about in the last macro higher time frame webinar, but it doesn't hurt to review again. Does that make sense? Any questions? So with that being said, on GJ, still looks like we got room for a little bit more upside before, even from a technical perspective, we start positioning and attempting high risk, high reward swing sells, day trade sells, and so forth. Looks like, give or take some pullbacks, if we're still holding above the 188s and where we saw some buy orders accumulated here, or just continuing further bullish on the intradays, that we can at least revisit the last highs printed and into these Brexit crisis prices before looking for better sell positioning. You can even see the reactions are very similar across the board, right? So here, where you started to get the major signs of sellers coming into the table and buyers getting out of the market or getting their liquidity swept out. You can see prior where we saw buy orders accumulated too, or where we saw a breakout of a previous high and continued a little higher too, right? You can see the general area here, that high printed here, the wick and retest into that area, and then the further signs of exhaustion here, right? And then the bearish sequence of events that really followed weeks and months later. And we can even see that here. And here you even had the break and retest above the high. Before shifting structure there, right? Pretty interesting, right? So even if this new quarterly candle, just from a technical perspective, from our retailer views, creates that wick and retests into here and still holds, or we just start breaking out higher, we could still be digging right into these Brexit crisis prices before seeing better higher time frame bearish positioning. One, we know that Bank of Japan clearly has to take a very slow and steady approach. Japanese yen is still bearish there. Two, we still have to see more data unfold. Three, we may not see BOJ start to raise rates until the other major central banks cut rates, Feds, ECB, Bank of England, to have that change of hands there with liquidity flows into foreign markets, right? And with that being said, and if Japanese yen is still going to be digging into some lower prices, outside of the intraday risk of stealth currency interventions, we could still be digging deeper into the 194s, 195s before seeing the better bearish plays and actual shift of structure there. Which we could easily retest into the 170s, 160s. Right? Right now on the intraday, we're just seeing an accumulation phase here. If we break below short-term bearish leg down, whether you want to scalp or day trade it, to the 188s before seeing better buys, or the continuation to the upside, breaking above the consolidation, still continuing the buys before looking to target into those Brexit prices for better sell positioning. Obviously, from a intraday perspective, you do want to watch the reaction at last highs printed here. If we're just going to break out higher and still respect intraday bullish structure with yen weakness, but I would love to be digging into those Brexit prices there. Last but not least, US 30 US stock market index. Now, I still see the liquidity inflows into these major risk assets and major asset classes. Dollar still moving sideways there, like we were talking about. Rate cut bet still holding the most weight. And us still going bullish probably up until the actual first rate cut. If we don't have any major new fear, uncertainty, or doubt to shift sentiment short term, or if we don't have any major acceleration in inflation reports to increase, or sorry, to push back rate cut bets and bring the market focus back on rates up higher for longer, if the Feds are going to keep taking a neutral monotone approach, then we're probably going to see this structure continuing to hold on US 30, going deeper and deeper into price discovery mode. And we might not see a bearish leg down or deeper bearish pullback until we go into the actual first expected rate cut, which is June. Then, if they do the actual expected rate cut, which is already anticipated and priced in, we may see a buy the rumor, sell the news play, which has taken place historically many times before. Whales liquidating positions from those fantastic all-time highs, short sellers taking advantage for a short period of time, and then that creating a more aggressive bearish leg before continuing the higher time frame buys. We have some beautiful macro structure here. And with the rate cut bets being in potentially June, we can see that further continued upside. And then with the buy the rumor, sell the news play, rate cuts being priced in, nothing new being brought to the table except the anticipated rate cut, buyers liquidating positions from the all-time highs, some aggressive pullback phases take place, where I'd at least anticipate bears in control for a couple of weeks, if not a couple of months, to be retesting minimum into the 37,500s, if not the retest of structure and like the 35,500s. Does that make sense to everybody? So with current liquidity still active and inflows heavy into the major asset classes, dollar still moving sideways and no major inflow into the currencies there, still having rate cut bets active, especially with Fed Powell's dovish tone from the last FOMC and what he said last week. PCE still in normal expected ranges, no major upside fluctuations or scares. Fed still expecting the soft landing approach. Very strong bullish price action, bullish structure. I do still see us squeezing further into price discovery mode, still playing the intraday buys and buys for the next few weeks if we don't have any major catalyst to shift otherwise. And then a buy the rumor, sell the news play into the actual first rate cut in June, leading to a couple of weeks of bears pullbacks before continuing the moves. On the intraday time frames, very solid structure formation. Even if we could retest into the key level 39,600s, or we had this minor accumulation and breakout and gap up higher, at least fill the gap into the retest of structure here. We'd love to see some continuation buys and going further into some new all-time highs still. No signs of a black swan event. You wouldn't have signs of a black swan event, but I was just making a joke there anyways. uh, no major fear, uncertainty, or doubt. Jay Powell not bringing any hawkish hammer down because they don't need to. Feds are in a good position with inflation and U.S. economic data. Dollar just moving sideways on the macro. Still have bullish price action and bullish structure. No major signs of exhaustion. Still riding the buys, in my opinion, at least into the actual first rate cut, if we don't have any catalyst to shift otherwise. Bitcoin, I'm still bullish too, bro. On the intraday, I just want to retest. If you just want some quick analysis, bro, I'll do the fresh analysis this week and tomorrow. But I'd love a retest of 67K before continuing higher. Otherwise, a breakout of this local resistance and starting to rally into the last all-time highs in 80K. Still bullish price action, market structure, fundamentals. But don't want to be yapping too long. It's more than an hour long, higher time frame review webinar. We'll do an updated Bitcoin analysis this week or next week. Oil, and then we'll do our weekly flow and weekly recap tomorrow. I just wanted to let some more price action develop. Obviously, we have the holiday in the Eurozone in some parts of Asia to start the new week. It's just the start of the new business quarter and business month, and then we'll get into it in the second half of the week.